Welcome back to the Rundown Lab, where we break down and fact check the biggest health podcasts. We know your time is valuable, but when you can, we always recommend catching the full episode. Links are in the description. Turn $27 into millions. What if I told you that investing the cost of a daily takeout meal could make you a millionaire? It's a compelling promise, and it's exactly the kind of claim that caught our attention in a recent viral episode of The Diary of a CEO. In this episode, the host discusses wealth building, financial habits, and the dramatic gap between those who build assets and those who don't. The video has racked up millions of views, with its bold title suggesting you can turn $27 into millions. So we decided to take a closer look at the specific claims made and separate the solid financial insights from the motivational hype. Let's start with what the episode gets right, because there's genuinely useful information here. The host claims that homeowners in America are worth 40 times more than renters. This is accurate. The Federal Reserve's Survey of Consumer Finances, which is considered the gold standard for this kind of data, consistently shows dramatic wealth disparities between homeowners and renters. The 2022 data shows median homeowner net worth of approximately $396,000, compared to just $10,400 for renters. That's roughly a 38-to-1 ratio. And in some previous survey years, it's been even higher, reaching 40-to-1 or 44-to-1. Now, an important caveat. This comparison shows correlation, not causation. Homeowners tend to be older, have higher incomes, and be more educated on average. Home equity essentially forces people to save through mortgage payments, but that 40 times gap isn't purely because of homeownership itself. Still, the core statistic is solid. The episode also mentions that 7 out of 10 people are living paycheck to paycheck. This is mostly accurate, though it sits at the higher end of credible estimates. Multiple surveys support figures in this range. Lending Club and PIMENT's research reports have shown 60 to 65% of Americans living paycheck to paycheck in recent years, and during inflation peaks, some surveys have approached 70%. The wrinkle here is that the definition of paycheck to paycheck varies significantly across surveys. Some include high earners who spend most of their income but have substantial assets. Others focus specifically on those with no financial cushion at all. So while the 70% figure isn't wrong, a more precise statement would be between 60 and 70%, depending on the survey and how the term is defined. Now let's look at where things get more complicated. The host states that more than 50% of Americans don't have savings. This is oversimplified in a way that could actually be discouraging to viewers. Here's the reality. Bankrate surveys have found that approximately 56 to 57% of Americans couldn't cover a $1,000 emergency expense from savings. But insufficient emergency savings is quite different from no savings at all. Meanwhile, Federal Reserve data shows that roughly 37% of adults couldn't cover even a $400 emergency without borrowing or selling something. So the claim conflates inadequate savings with zero savings. Many Americans have some savings, but not enough for emergencies. The specific number depends heavily on what threshold you use: $400, $1,000, or the often recommended 3 to 6 months of expenses. A more accurate statement would be more than 50% of Americans lack sufficient emergency savings. There's also a claim that when people are asked how much money would totally change their life, they say $10,000. The problem is, we couldn't locate a credible, widely cited survey with this specific finding. The vague attribution, just "they say," without identifying an actual source, makes verification impossible. Various financial services companies do conduct surveys on life-changing money amounts, but results vary widely, anywhere from $5,000 to over $50,000, depending on demographics and how the question is framed. This claim may come from a specific company's marketing survey, or it may be misremembered. Without a source, we simply can't verify it. Now for the headline claim that deserves the most scrutiny. The host suggests that if you invested $27.40 a day for 40 years, you'd have over $4,424,000. Let's break down why this is misleading, even though the math technically checks out under specific assumptions. To reach $4.4 million from about $10,000 per year over 40 years, you need to assume roughly 10 to 11% annual returns. And yes, the S&P 500's historical average is around 10%, so the math is plausible. But presenting this as a reliable outcome is where it becomes problematic. First, historical returns don't guarantee future results. This is such an important point that investment companies are legally required to tell you this. Second, the calculation assumes consistent 40-year investing with no withdrawals, no taxes, and no fees. Real life includes all three. Third, when you adjust for inflation, real returns for the S&P 500 are closer to 7%, which would yield roughly $2 million, not $4.4 million. Still a great outcome, but half of what's being promised. Fourth, this ignores something called sequence of returns risk. If you hit a major market downturn near the end of your 40 years, your actual results could be dramatically lower. And finally, it ignores behavioral factors. Most people don't invest perfectly consistently for 4 decades. They panic during crashes, they withdraw for emergencies, they change strategies. A more honest framing would be, assuming historical stock market returns of around 10% before inflation and fees, $27 a day for 40 years could potentially grow to around $4 million, though actual results vary significantly and past performance doesn't guarantee future returns. It's less catchy, but it's truthful. So what's the bottom line? This episode is typical of personal finance motivation content. It's directionally accurate, but sacrifices nuance for impact. The core message, that consistent investing over time builds wealth, is absolutely sound. The homeowner wealth gap statistic is solid. The paycheck-to-paycheck figures are in the right ballpark. But the headline claim about turning $27 into millions presents an optimistic scenario, as if it were a guaranteed outcome. It's not a lie, but it's not the full truth either. If this content motivates you to start investing, that's genuinely good. Just go in with realistic expectations. Consistent investing works, but the specific numbers you'll achieve depend on market conditions, your actual behavior, taxes, and fees. The habit matters more than hitting some magic number. Thanks for joining us. Stay curious, stay skeptical, and we'll see you next time.